Fine. So this is going to be our final session, as we discussed when it comes to the lecture series. Uh, and again, it is going to be a contemporary area, as you would have witnessed throughout the lecture series that we've been discussing, very contemporary areas. Similar to that, when it comes to this corporate failure, that is also very contemporary phenomena. It keeps happening from the past. Even from the 19th century or even beyond that maybe. And also we believe that we don't wish, but we believe that so this incidents, the corporate failure may even continue to happen in the future as well. So even if we all are to meet maybe in 10 to 20 times, 10 to 20 years time, certainly I believe that we may still be able to discuss this topic. So that's why we call them contemporary, right? Okay. Having said that, so the materials relating to that, there were a couple of additional readings even, uh, especially when it comes to predicting this corporate failure. It is very, I would say that very popular area, the predicting the corporate failure. So relating to that, I have uploaded two materials, the research papers, in fact, together with that case study and the lecture materials and the additional reading was uploaded. Okay, hope you'll have access that. And with that, let's move on to the today's discussion, the corporate fail. At the end of this session, you would be able to understand, demonstrate an understanding on the corporate failure. So in fact, what you mean by corporate failure, then you should have to have understanding about what are the causes of this corporate failure. And also there's a kind of strong relationship with the corporate governance and the failure. So in fact, it's a kind of negative relationship. So higher the corporate governance, there would be lesser the corporate failure. And also it works other way around as well. Then we are going to looking at some practical instances, the instances where the companies has gone bankrupt. Then we are going to make some learning out of that, and that is the anatomy of a corporate failure. So we are going to make some learning out of the failures. And then we discuss about the cost of corporate failure, then evaluate the factors used to predict the corporate failure. That is also important when it comes to organization. So if you can predict the corporate failure, so that will in a way help to minimize the damage, I would say. And then assess the likely indicators of corporate failure. And finally, evaluate how the regulations have been used to alleviate the effects of corporate failure. So these corporate failures has triggered some important regulations like the Sarbanes-Oxley Act, and even in the Australian context, there were lots of movement. Not only that, even throughout the world, I would say. So it triggers some regulation, the need for some regulations, and that is also going to be discussed in the today's session. So it's a very, I would say that very, when it comes to the scope, it's a very small area, the corporate failure, I would say that, but it is still important when it comes to the practical. In practical terms, it is a devastating incident, the corporate failure. So that might mark the end of a entity, right? So therefore, it is in practical terms, it is pretty much important. Okay, having taken you through the learning outcomes, let us first see what do you mean by this corporate failure? So in fact, when it comes to this corporate failure, there's no standard definition, right? So if you ask me what is the objective of financial reporting, we have seen that there's a particular definition on that. If you ask me what is The definition of an asset, yes, there is a particular definition. But when it comes to the corporate failure, we cannot say this is exactly the corporate failure. But instead, there are different terms what we use in this context. And at the same time, we look at how it works in the practice. And depending on that, we try to describe this corporate failure. So therefore, we cannot provide you with a standard definition on the corporate failure. What is meant by the distress of the organization? Yeah, good. You're asking me what is the distress. Yes, that is also, in a way, it is a kind of corporate failure. So the distressed company may be a company that is struggling. The company that is struggling for the survival, hence, they may be in their way to the bankruptcy. They may be in their way to the insolvency. So that is what we call the distress organization. So they are struggling for the survival. Good. Then when it comes to this corporate failure, we often use the term bankruptcy or even the insolvency. So the term bankruptcy, it is quite popular when it comes to the US context. In the USA, the bankruptcy term is popularly used for this corporate failure. Whereas when it comes to the other part of the world, if you take Australian context, they usually use this insolvency, that is for the corporate entities. For the corporate entities, they use the term insolvency. And they reserve this bankruptcy, that is for the bankruptcy of a particular person. For individual, they use the term bankruptcy, but for an entity, they most of the time use the insolvency. And that is the case in the Australian context. And even sometimes we used to say that the corporate failure, we known them as the failure, or even we can say default. The company is becoming default. I heard that in Sri Lankan context, most of the time we trying to use the term default, right? The companies are becoming default. So that is also the corporate failure. So I must say that this is the extreme end of the corporate failure. So the bankruptcy, the insolvency. So even in the recent past, we have seen that the certain entities has gone into the bankruptcy. If you take that, the ETI Finance, they are on their way to this insolvency. Still, they are making to certain extent for their customers. They are making the settlement, but it is not guaranteed that whether these customers are going to receive their payment in full. But time to time, they manage to make payments. We have seen. But apart from that, yes, the Selinco, when it comes to Selinco, it is so that is a company, the well known example. So in our context, that has gone bankrupt. Even the
The
Sakti's business, yeah,
the finance company.
the finance company is that. It is also recently added one, no?
Yeah, recently the
Yeah.
same
Things went
issues.
wrong with them as well, no?
Investors are facing a lot of issues to recover their deposits and the
Hmm.
investments.
Yeah, when they were established, this
Yeah, 1987 like that. So,
is that. So they
yeah,
are having some kind of history, no? So like nearly 30 years of history. But
yeah, nearly after 30 years.
do you have any idea that how they have gone bankrupt?
Yeah,
What went
uh,
wrong with them?
yeah. Earlier, sir, the Sabra organization,
Mm-hmm.
like called the Sabra, that finance company also was bankruptcy.
Bankruptcy, yeah. Yeah, I was
Sabra.
asking about do you have any idea about the root cause? What would have been the case that they have
Actually,
gone
they
into
have not diversified their investments in the foreign investment properties. They have located within the local investment properties, and also the corporate. The
yeah, they
main
have
reason.
restricted themselves only to finance, right? Uh, they could have sometimes if they have diversified to a certain extent, they could have even managed when the economy is having some
Yeah,
downturns,
the
they could have
company was
survived something like that.
unable to face immediate sudden economic recession faced
Is
by the
that
company. That
the recent economic recession has paved the
yeah,
way for them to bankruptcy?
once they invest in diversified manner in foreign investment properties, they
Mhm.
would have managed, I think.
Yeah, yeah, it's good to know that, right? It is a very recent incident. Yeah, good. Right. Thank you very much. Uh, so similarly, you can see that when comes this bankruptcy, it is something not even new to our context. So in the recent past, we have examples. Even if you take 10 to 15 years back, even we can find some examples. The famous cases was that the Golden Key company and also the Premco Bank and also the Sakvitis business. So those are the incidents that we have gone through in the past. And also, as I said, it is happening now, and even in the future, there's no guarantee the corporate failures can be there. Corporate failures can even be there. And even when it comes to this research, so this is a very popular research area. Even this is a very interesting area when it comes to the researchers' point of view. So in that, so when it comes to the research, there we also see a kind of huge diversity, especially when it comes to defining these corporate failures. So if you take the different research, you may find the different definitions have been adapted. So what do you mean by this corporate failure? Some would say that the company who has filing for the bankruptcy is a company that we considered as failed. Or sometimes the one can define this corporate failure as the companies who are delisting uh, for whatever reason, maybe the liquidation or maybe the mergers or whatever the reason. And even the one can define this corporate failure as entities who are ceasing to trade. The entities who are ceasing to trade, that is also the corporate failure. And also one can say that the entities who are entering into receivership, the entities who are entering into liquidation. So that is also the failure. So likewise, when it comes to this corporate failure, it's a very vast area. So therefore, different kinds of definitions can be provided, right? Then out of that, one of the very famous kind of definition that was provided by the DNB, it's a global company who engage in research into this business failure as well as the entity who are providing the business organization with the insights. They have once defined the corporate failure. Yes, yeah, correct. Delisting, it is about delisting from the stock exchange. Yeah. So you are a listed entity, then you are delisted. So when you fail to achieve the thresholds, when you fail to satisfy the threshold, yes, the relevant authorities would take action to delist you. Yes, that is a delisting from the stock market. Yeah. So according to this DNB, the global entity, so how they define the corporate failure, let's see. They say that the businesses that cease operating following bankruptcy. They identify that the business failure, so there you would find the businesses would cease operations following the bankruptcy. Those that cease with loss to creditors after such action and execution. As a consequence of this ceasing the trade, ceasing the operation, you would find that it would create loss to creditors. They are the ones who are going to suffer. Those who have provided the fund to the business organization, they would suffer upon these actions. And when it comes to these creditors, position, some of those voluntarily withdraw, leaving unpaid obligation. Some creditors simply give up. They are not going to worry about that. They simply give up and they simply withdraw. So therefore, some of the creditors can voluntarily withdraw, leaving unpaid obligation. But at the same time, Those that have been involved in court action such as receivership, bankruptcy, reorganization, or arrangement. But at the same time, there can be a set of creditors who may not simply give up. They may even go for the court. They may look for the receivership. They may look for a liquidation, the bankruptcy reorganization, or any other arrangement. And then they would try to uh, achieve something. They may try to receive some. So therefore, they would eventually voluntarily compromise with creditors. They would be able to sometime to recover the full amount, or sometimes they may compromise and they may settle with a kind of a payment which is not the full amount. So therefore, it seems that it is a very comprehensive definition. It talks about how this bankruptcy happens, and as a matter of that, how it impacts to the creditors, and not only that, even that extent, what are the actions these creditors can take, and what would be the ultimate uh, implication, ultimate consequence, something as such. So therefore, this is a kind of very comprehensive definition that was adapted. But in this definition, we can pick up several key aspects. The one thing is that as a matter of this business failure, most of the business organization would cease their operation. So then it has a significant impact to the creditors, and some of these creditors may simply give up and they voluntarily withdraw, while some may look for the alternatives, that is to recover their money. So in that, they might look for liquidation, the receivership, or bankruptcy reorganization. Through that, they may try to cover all of their outstanding, or sometimes they may voluntarily compromise, then they may settle with something less, something less. So that is how this bankruptcy works. A significant indication of corporate failure could be the appointment of voluntary administrators. So in most of the cases, when it comes to this corporate failure, most of the time the board would make a decision. So when they find that they are approaching towards the bankruptcy, they would make a decision to appoint voluntary administrators. So they are the expert, the professionals. You are going to take the service of the professionals, and that has to be decided by the board of directors. Or even sometimes when a particular entity has some secured creditors, they would even take that action even prior to the board of directors. So because their money is invested in that business organization. So if that business organization is approaching towards the bankruptcy, so the creditors would ask, or creditors would take the action to appoint a kind of voluntary administrators. So therefore, this process can be initiated by the board of directors or even the secured creditors. So they have that right to take the service from the professional service providers. Those are the administrators. Most of the time it is provided by the accountants, and there can be firms most of the time. So it would comprises of the accountants, the lawyers, likewise the professionals are there. They would undertake the business organization and they would handle the business thereon. So once these administrators are appointed, what is their role? So they are going to investigate the affairs of the company. So they are going to look at the current state of the company, and they would try to find a way to save the business. In fact, that's what they do very first. The very first thing what they would do, they would try to uh, keep this entity on the going concern. So they are going to ensure that not to close the entity, not to cease the operation, but somehow to look for the alternatives, look for the solutions, and try to keep this organization in going concern. So they may try to manage the business. However, failing to do so, what they must do, they must uh, think of the liquidation, and in that, their primary responsibility is towards the creditors, and they are supposed to act in the best interest of the creditors, and they need to ensure that at the end of the day, the interest of the creditors is maximized. And that is what it is expected from the administrator. First, they would try to save the company and they would try to keep them in going concern. But failing to do that, what they must do next, they must go for the liquidation. In that, what they would do, they must take the creditors' interest as their prime concern, and they should try to maximize the return to the creditors. So that is what must be the role of an administrator. And even when it comes to this corporate failure, as I said, that it can range uh, from the bankruptcy and the insolvency, and also the liquidity issues, and even to the technical default. So in the lowest end, you can see that even you can say the corporate failure, you can identify corporate failure as a kind of a technical default. The default on a debt agreement can also be associated with corporate distress. A technical default usually is seen when a company has violated a condition of a debt agreement. So you have obtained certain loans, from the uh, different financial institutions or maybe the banks. Likewise, in such an instance, the debt covenants are there. So in such an instance, if you have violated such a debt covenant, you would find that it is a kind of a default. For example, in some instances, you might have to maintain a liquidity ratio. So you would have to maintain some sort of a liquidity. So, but if you fail to do that, if you fail to maintain these liquidity ratios, so it is taken as a default. So if that happens, that could even dictate the corporate failure. So therefore, when it comes to this corporate failure, it is not always the bankruptcy and the insolvency. Even technical default could even mean that would pave the way for the entity for the failure. So therefore, this business failure can relate to anything from the technical default on a debt agreement, signaling the company is having liquidity issues, to bankruptcy or insolvency. That's why I said this is a very vast area. In the extreme end, you would find the bankruptcy and the insolvency. But on the lowest end, you may find the technical default on a particular debt agreement. That could even termed as the corporate failure. So therefore, it is not always the bankruptcy and the insolvency, but that is the extreme end. But in the lowest end, even if you become default on a particular loan, that could even mean the corporate failure, right? So therefore, the providing a precise definition on corporate failure is somewhat difficult. For creditors use a company claiming dues, triggering the company to declare bankruptcy and get paid, right? So what is the best move as a creditor when you company getting bankruptcy but you have outstanding debt rather than time of money? Yes. When it comes to the creditor's position, so most of the time when it comes to this liquidation, so when you appoint these administrators, that is the kind of action but these creditors can look into. So in such an instance, uh, even the administrator decide that the liquidation is the only option, the priority is first given to the secured creditors. So if you are a secured creditor, then there is a higher chance that you could get a claim. You would be able to get a claim. But if you are not a kind of secured creditor, then the chance that your outstanding would be settled uh, is quite, I would say, problematic, because you are not in the priority list. The priority is given to the secured creditors. So having paid the secured creditors, then if some excess money is left, and there's a chance that you may be getting the opportunity to receive some. So therefore, it is pretty much important as a creditor. You must first look for what is your position. So are you a secured creditor or not? So depending on that, it decides the priority. So therefore, that must be the best approach. Rather than wasting your time and money, you must think what is your position. Yeah. Good. You're coming up with the questions, concerns, suggestions. That is great, right? Okay. So far, we basically discussed about the corporate failure. So then finally, we found that the corporate failure is something difficult to define. And in that, we found that it, what do you call it, is spread in a kind of vast area, and it starts from the very low end of technical default and to the extreme end of the bankruptcy, or what we call the insolvency. Okay, then what are the cost of this failure? So what are the implications? What are the cost implications of this failure? And an entity who take their way towards the bankruptcy, what are the costs that they would have? So basically, we divide these costs into two categories. We call them the direct cost as well as the indirect cost. The direct costs are the more obvious one, especially if you are going to take the service of administrator, you would have to incur some professional fees. Especially, you have to pay the lawyers, you would have to pay the accountant, the restructuring advisors, likewise, insolvency practitioners, you would have to pay. So therefore, it is a kind of a direct cost. When it comes to this administration, when it comes to this liquidation, what these administrators do first. So out of the money, first they are going to ensure that their fees are secured. So first they are going to cover up the fees, and then thereafter they are moving towards the secured creditors. So earlier I couldn't mention that, in fact, the very first priority is given to themselves. So they ensure that depending on the time that they are going to manage this business, it can be 6 month time or even more than that. Considering that time period, they are going to work out what is their fee. So first they are going to cover up their fees. Then they are going to look for the secured creditors. And that is how the priority goes. So even I have witnessed in most of the time research papers that especially when it comes to this the context of football. So this failure, the corporate failures or bankruptcy is pretty much obvious thing. So it happens frequently. So considering the cost involved, especially the cost of the players. So there were cases that even the football clubs used to pay these creditors, the players more than their sales revenue. So there are instances as such. So therefore, it's a game of reputation. So when it comes to the football, it's something goes beyond the financial terms. It's a game of reputation. They look for the reputation. So therefore, sometimes they are going to attract the players by paying uh, more than their sales revenue. So in such an instance, sometimes it would even dictate the end of the club. So they have filed for the bankruptcy. In those instances, when they are looking for the service of the administrators, what has happened is, so when it comes to these fees of the administrators, whatever the money that they would get out of the sale of the assets, it is quite near to the fees of these professionals. So therefore, only small sum of money is left for the creditors. So therefore, they are taking the administrators, it's themselves are taking the huge part. So therefore, this is a very direct expense, right? And also the additional interest on holding debt that cannot be discharged. When you're struggling, when you're in a distress situation, you would find it difficult to pay your debts on time. So if you do not have adequate cash flows, what you would have to do is you would somehow manage to keep these loans going just by paying the interest. So therefore, you may simply ended up paying the additional interest. So you cannot settle the loans on time. So therefore, you need to look for extensions. So in that, the additional interest has to be paid. And also you might have to renegotiate the loans. So as I said earlier, so if you have failed to satisfy the debt covenants, right? So what you would have to do is that you need to renegotiate. As a matter of that, it is going to be a costly exercise. So again, the refinancing cost is going to be high. Those are some of the direct costs and very obvious ones. Apart from that, when you are approaching towards the bankruptcy, when you default on a particular loan, you would find that even some indirect cost would involve. Indirect cost would involve. The cost like the reputation cost, the companies who are approaching towards the bankruptcy, the customers would uh, hesitate. Customers would hesitate or even refuse to purchase from you. So therefore, in terms of lost sales, in terms of lost profit, so there is a cost. And at the same time, there can be some opportunity cost. So you are going to lose some of your key management personnel. You are going to lose them. And also, now you are concentrating more on the survival of the business rather than looking for the opportunities to expand your business. You must have to concentrate on the survival of the business. So therefore, there is a opportunity cost. And also, when it comes to the financing, the companies who are approaching towards the bankruptcy, they may really struggle to secure some loans. So even if they manage to secure, they comes at a huge cost in terms of interest. You would have to pay a huge interest cost. So therefore, that is also a opportunity cost. So the failure, that's why I said that it is, in practical terms, it is a very devastating move. It's a very devastating incident for a business organization. Then we look for the causes of corporate failures. So what will cause the corporate to fail? What will cause the corporates to fail? It says that there are many reasons why companies fail. The most for multiple reasons. You cannot identify what is the root cause, but instead you may find that it's a very complicated scenario that the multiple factors can contribute towards a failure. So there can be multiple reasons. The corporate decline can stem from multiple sources, both inside and outside of the organization. The inside factors and outside factors would contribute towards this failure. These multiple elements often make it difficult for the managers to comprehend and address the causes of the corporate failure. So you would find that because of this complexity, the multiple reasons are involved, the multiple causes are involved. So because of that, the managers would struggle to deal with this situation because you cannot exactly identify a reason, but instead there are multiple reasons. So dealing with the multiple reason is not going to be an easy task. So therefore, managers would find themselves struggling to look for the ways to get out of this. Then causes of corporate failures, the outside factors. So I said that there can be inside factors as well as outside factors. Let's see some of the outside factors that would contribute towards the corporate failure. The one dominant reason that comes from the outside, the external environment, it is the change in the technology. When the technology change, you would find that some companies would go bankrupt, especially the companies, those who cannot keep up with the technology change. So I can remember that, especially when it comes to that, the Kodak companies, they have approached the bankruptcy when there is a shift in the technology in the camera. So in the field of cameras, so when there's a shift in the technology, they have struggled. And not only that, even once the Nokia company, who has occupied the #1 position. So in the face of the technology, they have failed to keep up with that, and even they have gone up for the bankruptcy. And after some times now, they have again recovered and they have come back. but earlier or they failed to keep up with the technology. That is another very popular example. The companies, those who have gone bankrupt because they could not keep up with the technology. So when the new technology evolves, so you must be able to keep up with that. Otherwise, you may become irrelevant. You may become irrelevant. And also the obvious reason, what we have discussed earlier, even the recession. So as your friend has very correctly highlighted that the most recent collapse, what do you call that, the finance, that was a result of the recession. The recession itself has paved the way for this company to gone into bankruptcy. And then the competitors' action. So the competitors' action that is another determining factor when it comes to the corporate failure, especially when it comes to, as I can remember that in Sri Lanka we have that the very first telecommunication provider, if I'm not mistaken, that is the Celtel, right? They are the ones who were dominating the market for some time. But after that, the Dialog, the Mobitel, they have come to the market and they have read the market really well, and they have responded, and they have able to dominate the market. They have able to dominate the market, and the Celtel has gone out from the market. After some time, they become Tigo, but even that didn't work. Even they looked for several other movements. That was a failure. Finally, they left the market. They couldn't keep up with the competition. So the competition is another factor. And deregulation or changes in the import protection in an industry. So when the government make the decision, so they can protect the industry as well as they can destroy the industry. So if they look for more liberation, a more liberal kind of policy. So if they are to lift the import restrictions, sometimes some industries, the local industries, can get affected. So sometimes even it means the end of those business organizations. So the deregulation or the change in import protection could also be the case. Not only that, even the interest rate changes. So, when it comes to the business finance, popular way of financing is going to be the debt capital. So if you have finance through the debts, if the interest rates go up, that would mean that you would have to pay more. So sometimes it might dictate even the end of the business. You may fail to keep up with the debt covenants, and as a matter of that, sometimes it might uh, file for. So they might even file cases, right? They may file cases in the court, and as a matter of that, you would find that that will dictate the end of the business organization even. So likewise, these are some of the external factors that you would find that will dictate the end of a business organization. So would you like to add something to this? You might have some interesting stories, some experiences even where the companies have struggled because of these external factors. Even sometimes it might dictate the end of those business organization. Can you add some more examples for that?
Sir, can we consider about political influences?
Yes, that is even, yeah, political, yeah. So that plays a crucial role, isn't it? The politics. So that can destroy some business organization. So what are those instances that comes to our mind that?
Yes, sir. Excuse me.
Yeah,
And
yeah,
uh, now we consider the finance, which was we discussed earlier, about the finance company
yeah,
got bankruptcy. So
yeah.
the finance company has wind up the business and left the market. But according to the Ceylon Bank, it
Mm-hmm.
got the bankruptcy but took over by the central bank and
Uh-huh.
functions again. So shall we take as a bankruptcy in the both scenario? Shall we treat as a corporate failure or whatever the situation?
Yeah, as I said earlier, when it comes to this corporate failure, we define it in a broader term. So in this particular instance, so when it comes to that ETI finance even, according to my understanding, now they are operating under the central bank. So they time to time make payment for their customers, in the sense the creditors. So in that particular case, what they are doing is that it's a simple liquidation. So they are liquidating the company, isn't it? They somehow trying to, in that sense, the central bank is performing the administrator's role. That is what they are doing. So they have
Yes,
found that they cannot, what do you call that, to keep the business in the going concern. So therefore, they are simply in the way of a kind of a liquidation. So therefore, to the maximum possible, they might make the claims, they might pay the claims, but once they can't, they are going to stop, and they will simply, they will try to minimize the damage. That's what I feel. So therefore,
yes, sir.
central bank is at the moment playing the role of administrator. This is
Yes,
a
sir.
corporate failure, yeah.
Yeah, actually, the corporate, my point is now asking about that both situation. The some companies face the wind up position and
Yeah,
left the market, so that can be treated as a corporate failure. In some instance, some companies recover from their bankruptcy and functions again. So both situation can be treated as a corporate failure. Also, the
yeah.
only the organization which left the market can be treated as a corporate failure.
Corporate failure, yeah. Yes, when it comes to that corporate failure definition, yes, you asking that some companies somehow manage to face
Yeah, they
that
are
situation and
recovering.
come back and operate in the going concern, right?
Some have left the market
Yeah, some have left
after
the market.
bankruptcy.
So obviously, the ones who have left the market, it's a corporate failure. That in this instance also, corporate failure, they have somehow recovered that situation. So
Yeah,
therefore, we cannot necessarily say that because they are not ceasing the operations now.
yeah,
They have somehow managed to keep up the operation. So therefore, they have faced the corporate failure, then they have come back. Something
okay,
like that. Ne? They have
okay,
struggled, but it is, in a way, we can say that it's a corporate failure, because even at the lowest end, we can even consider, if we have failed to keep up with a particular debt threshold, even that is also dictated as the corporate failure. So therefore,
yes,
they are going into the corporate failure, but somehow they come back, and then they kind of be, then they are going to sustain. Then they are going
okay.
to somehow sustain.
Thank you, sir.
So therefore, there's no harm that saying that they have gone into the failure and came back, or otherwise we can even say, since they do not cease the operations, they have managed this corporate failure well, and they have succeeded, something like that.
Thank you, sir. Thank you.
Yeah,
That's
good.
it. I got point.
Yes, one example you have mentioned, the kick cola. Now we don't have that, no? Yeah, I can remember that some time ago the kick cola was there in the market, but now they are no longer there, no? So they have vanished the market. Okay, good. So it was the Coca-Cola. Even I can remember that I have heard when is it, if I'm not mistaken, that yeah, but that time it did not went up to corporate failure. It was a kind of very kind of negative kind of strategy, that when Coca-Cola or Pepsi-Cola enter in the market, what they have used to do, they have used to purchase all the stocks of the kind of the competitor and destroyed that. So likewise, sometimes creating a kind of vacuum in the market and taking their position, something like that. But that didn't went up to that corporate failure. Yeah. Kick Cola, that was the case. Okay. Then Mundo Gas, right? Incident in Sri Lanka. So it was there for some time, but now we don't have it. Okay. When restaurant had to close down due to the bad economic condition after COVID, yes, we have witnessed that many have struggled, the restaurant businesses. Yeah. economic distress, that is the recession. That is what we call the recession. So the recession, yeah, good. So likewise, this is a very practical thing, very uh, practical thing that we feel even on a day-to-day basis. Even we, at least we heard about that. Good. Then let's look for some mismanagement. It is something to do with, it comes under the internal factors. We'll see. Good. Okay. Then now we'll move on to the inside factors. We discuss some of the external factors, but this is not the complete list. But this is something they have identified through the research, but there can be many more, as one of your friends added, the political situation. It is a, yes, I would say that that must comes in the top of the table. The inside factors. When it comes to these inside factors, you can see the weak strategy. So if you fail to read the market, so if you do not understand the impact of the external environment, you fail to set the strategy. So if you fail in strategy, that might dictate the end of your business organization. So then you can drive towards the corporate failure. So the strategy is what makes the business the going concern. So I could see that one of the, I would say that even in this, the hard times, even during hard times, the strategy that is adopted by uh, the restaurants, I would say, no, the restaurants, the very famous hotels and restaurants, what they have done. So they have managed to convert their, what do you call that, the accommodations that is for the patients. Earlier, they provide the accommodation that is for customers, but then they change their market. Now they are operating them as uh, the accommodation that is for the COVID patient. So it was a wonderful strategy, isn't it? So even during these hard times, they have somehow managed. And even when it comes to these packages, these prices are exactly similar to the packages what they have offered for the customer. So one day, 15,000. So usually if you go and spend one day there, and that is the normal price for a customer. So therefore only the mode, only the type of customer has changed to the different segment. Now you are catering, and but you have somehow managed to survive. So therefore, according to my point of view, it is a wonderful strategy during the hard times. It's a weak, so therefore they are good at strategy. But if you fail, yes, that might dictate the end of your business, especially during the hard times like the COVID pandemic. Then the financial mismanagement, especially this is the case. It is pretty obvious. So if the inside person used to take the money for their own use, so that would also an example for the financial mismanagement. So most of the cases, we have seen that if you take this golden key company failure, so the obvious reason is that the managers have treated themselves better. So they use managers, not only the managers, but even the directors. The directors have treated themselves better, right? So as a matter of that, the companies have failed. And not only that, if you even take that the famous Enron collapse, in those instances also something to do with the financial management. They have not hedged their risk very well. So they have failed to hedge the risk what they are facing very well. So as a matter of that, that has dictated the end of the business organization. So the financial mismanagement takes the priority when it comes to the inside factors. Then the dysfunctional culture. So if you have a culture which is not supportive, which is not performance driven, that would even dictate the corporate failure. Especially if you take most of the organizations that is managed by the government, especially, you would find that their culture is dysfunction. Their culture is dysfunction. So they are not considering about the performance. They focus more on the waste, the corruption, the bribery. So those things are the dominant characteristic of the culture. So therefore, it is quite dysfunctional. So that does not facilitate the business organization to succeed, but instead that will mean the failure. So the culture is one of the significant factor, the inside factor that would decide uh, the survival of the business organization. So likewise, these are some of the insider factors. So the point here is that when it comes to a failure, there could be external factors as well as the internal factors. But even we cannot say there's one dominant reason, but most of the time it could be the multiple reason. The external factors and the internal factors together would mean the failure of a business organization. But these are some of the factors that was identified as some important factors in the previous research. While there are many factors that can contribute to the corporate failure, research of some high-profile failures has identified specific management inadequacies that appear to contribute significantly. Out of the many reasons, though we agree that the many factors would contribute for the failure, the most significant one is going to be the management inadequacies. So the financial mismanagement and their failure to set the strategy. So those would mean the most significant reason. So the management inadequacies would play a crucial role in the corporate failure. So they are the ones who would decide the success or failure of a business organization. So if they are good at setting the strategies, as I said, that even during the hard times, if you can manage to do that, yes, you're going to be successful. But if you fail to adopt strategies really well, if you fail to read the market, if you do not understand the impact of the external factors, certainly that will dictate the end of the business. The prominent corporate failures, we have heard of this Enron collapse, the famous one, then the HIH, the WorldCom, ABC Learning, Tyco, and the Palm World, right? Not sure about that. So these are some of the famous failures in the corporate world. The Enron collapse, it was a very famous one, and also the WorldCom. So these are very famous. HIH, right? In all those incidents, the dominant reason was that something to do with the auditors. So auditors have misrepresented the organization. So in fact, that would even dictate the end of those audit firms. So this HIH, the Enron, those audits were handled by the Arthur Andersen. So one of the very famous audit firms before it was in fact known as the top six audit firms, the big six, big six audit firms at that time. But once they left, then it became the top five audit firms. So the Arthur Andersen was one of the top six audit firms at that time. But however, they have misrepresented the organizations. There were problems in providing their independence was questionable. As a matter of that has dictated the end of the business organization. It was big five. Is that? It was big five. Now it is big four, right? Okay, sorry. So it was a mistake. At the time where the Arthur Andersen was there, it was a big five. Now, once the Arthur Andersen has ceased the operations, now we have the big four. Okay, thank you very much. Okay. Then, depending on these famous corporate failures, this Hamilton and Micklethwait, right? Not sure about pronunciation. So H&M, let's say, believe that the main causes of failure can be grouped into 6 categories. By referring to these famous collapses, they have managed to identify some reasons. It is in fact 6 categories of reasons what would cause the corporate entities to fail. The very first thing, as we discussed, it is something to do with the management, the poor strategic decisions. So the management, when they're expanding into different markets, different products, they fail to identify the drivers of the market, the value drivers of the market. They fail to identify. As a result of that, they ended up setting poor strategies, and that is not going to work. And even they make poor strategic decisions, that would be a failure. That could be one thing. It is something to do with the management. Then the other thing is that the greed and the desire for power, again something to do with the management. When it comes to this, the high achieving executives, so they may become too ambitious. They can become too ambitious, and then they would pursue some aggressive strategies, the aggressive acquisitions. Likewise, they can pursue some aggressive strategies, and even go for some expansion. Sometimes that may not be sustainable. So that can be afforded by the company. So therefore, the greediness and the desire for power of the high achieving persons could even mean that that is the end of the business organization, right? That could be the case. Corporate governance involved. Yes, we are going to discuss that as well. The greed and the desire for power, that is something pretty much witnessed. Even we would see that when it comes to the Sri Lankan corporate world, there are some giants, but and sometimes I felt that are they too aggressive even? So when it comes to this, the Dhammika Pereira, if you take that, even the owner of that, the Softlogics, you take these personnel, sometimes I feel that they are too aggressive. They are too aggressive, especially in the expansion. Sometimes even it could mean that it may not be sustainable in the future. So therefore, need to be little conscious, especially when it comes to the expansion, that expansion must be something affordable or something manageable by the business organization. So therefore, the greed and desire for power of the executives, the managers, is another factor. And also the overexpansion and ill-judged acquisition. So when it comes to this acquisition, that is a particular area where the things can go wrong, especially though they are financially profitable entities. So before these mergers, before these acquisitions, so once they become a single entity, once they uh, become a merger, what happens is that you would find most of the times the cultures are dysfunctional. The cultures are not compatible. So the two different cultures. So as a matter of that, even that itself could dictate the end of the business organization, right? So therefore, you need to look at the integration. When it comes to this integration, the acquisition, those has to be something that you should very carefully do. So you need to think about the integration the most. So if it is questionable, if it is problematic, certainly that could mean the end of the business organization. So can we come up with some example for these mergers have went wrong? So in Sri Lanka, so I can remember even in one instance, if I'm not mistaken, that the Google and Nokia has went into a kind of merger, isn't it? Google and Nokia company. Once they have went into merger and that was not successful, after some time they have separated. So likewise in Sri Lanka, so what are the mergers that has gone wrong? So you can think of some examples here. So especially this is an area where the things would go wrong. It doesn't go favorably most of the time. The overexpansion or the ill-judged acquisitions. And the dominant CEOs. So when the CEO become dominant, the board would find it difficult to control the CEO, right? Then even the board would tend to depend on the CEO. So if that is the case, that could even sometimes mean the end of the business organization. The CEO becoming more dominant. So the board would find it difficult to control this personnel. So therefore, the board would become complacent. As a matter of that, sometimes it could mean the end of the business. And the failure of internal controls. So this is particularly important when it comes to the internal controls. You need to have them in place. So this is something to do with the corporate governance, even as you have asked earlier. So you need to very carefully look at the risk, what these entities taking. So this risk mitigation uh, activities, whatever the internal controls relating to that. So you need to be careful with that. So otherwise it would mean the failure of internal controls. The ineffective boards, and at the same time when it comes to the board, uh, they may fail to provide a kind of independent direction to the organization. So they can be ineffective. So they might simply depend on the management committee. So they are not going to provide a kind of independent direction. So they may not meet regularly. They may not discuss the important changes that is going on in the external environment or even the internal environment. So if that is the case, so they fail to perform the comply with the performance role and the conformance role. If they fail in doing so, certainly that would even dictate the end. So when it comes to performance, that is there where they set the strategies, where they set the goals for the organization. So in fact, they need to set the corporate plan, right? They need to come up with the corporate plan, the strategies, the goals has to be set. And not only that, even they need to make sure that the organization, the management committee, and they are ensuring that the organization is working towards these goals. So thereby the performance measurement system has to be there. Those has to be established, and also ensure that the compensation is what do you call that, the fairly compensated, these management personnel, the leaders of the business, those aspects, and also the risk management, those has to be considered. So therefore, if the board is ineffective, that is also a major cause of corporate failure. So you can take out of these reasons, these ineffective boards, the failure of internal controls, the dominant CEO, those are some of the things to do with the corporate governance. We are specifically discussing them later as well. Right. The problems with management of companies. So again, relating to the previous aspects, what we discussed, the managers may use the resources to benefit of themselves, as I even mentioned earlier, especially in the case of the Golden Key credit card company. This was particularly the issue with the management. So we agree that the management problems would dictate the end of the business. So therefore, if you look at the root cause of failure in the Golden Key credit card company, the managers has used the resources to their own benefit. They have treated themselves well. Then also sometimes they take actions that stakeholders consider not desirable. So if you go against the stakeholders, they simply focus on the bottom line, it is not going to work. And that was especially the case when it comes to this the Sanlu, right? The group China. So they have produced the milk powders, and they have contaminated with the harmful chemical substance, melamine, and even that uh, has caused even few infant to die. So that is where this case had got heated, and that would even dictate the end of the business organization. So in the pursuit of profit, they have become blind. They have no respect towards the social values. They have not respect towards the humans. All what they consider was a profit. All what they pursue is a profit. So, but at the end of the day, that greediness itself has dictated the end of the business organization. So that is another incident where you have failed to consider the stakeholder concerns. Sometimes even the high door provide false information to shareholders would even mean the end of the business. especially when it comes to Enron, they fail to inform the shareholders of the true level of debts. So here, the crucial part has to be played by the auditors. When it comes to the auditors, they were quite biased towards the management, the Enron, and even it was said that when it comes to this Enron, they have occupied even once they have even outsourced their internal audit function to these external auditors. That kind of in that extreme, they have had the relationship with these auditors, and even these past uh, partners, the partners of this Enron, they sorry, the Arthur Andersen, they used to serve even in the Enron. So that kind of relationship was there. So likewise, it was the independence was questionable, the audit. So therefore, they failed to provide a true and fair view, and eventually that has marked the end of Enron as well as the Arthur Andersen. The WorldCom, they have incorrectly recorded the expenses as asset to increase the reported profit. So it's a kind of earning management, what we discussed. So they have capitalized the expenses where they should not. That have also marked the end. And also the Touchwood case, it is a very familiar case, the local one. So there we have seen that they have exploited the standard when this agriculture standard was issued initially. There it was given that for this bearer plant, uh, so they were given the opportunity to measure the fair value less cost to sell and recognize these fair value changes in the profit or loss. Then when the trees were at a very immature state, they used to measure them at fair value, and they have made a significant profit. Not only that, depending on those profit, they used to even pay dividends. So the things are getting worse and worse. So that is something to do with the local company. That is also very unhealthy practice adopted by the organization. So likewise, so far it was clear from this discussion that when it comes to this corporate failure, especially when it comes to these factors, there we can see that the internal factors has to play a crucial role. So most of the time, it is something to do with the management. So therefore, the specific management inadequacies is what would dictate most of the time the failure. So if you take even these 6 reasons, so you can see that none of them are more towards the external. So almost all of them are internal oriented, isn't it? The poor strategic decision making, it is something to do with the management. The greediness and desire for power, that is something to do with the management. Overexpansion, ill judgment, management. Dominant CEO, management. Failure to internal controls, that is also management. So the ineffective boards, that is something to do with the management. So management in the sense the board of directors and the management committee. So all together. So therefore, almost all the reasons, right, uh, are internal. Internal factors are more dominant. And even in these instances, you can see that that is some more examples. And in those instances also the root cause is something to do with the management. So almost all the instances. So therefore this corporate failure, we can reasonably conclude that it is more of or it is something more to do with the internal factors. So the external factors would contribute, but compared to the internal factors, it seems that the external factor impact is minimal. But the internal factors, yes, it makes a huge one. Right. Then we are moving on to the corporate governance. I think before we move on to this section, so now it is 55 minutes past 4. It is better to take a break. Let's take a break of 15 minutes and continue, right? So we've been talking for about 2 hours time. I think it is better to go for a break and continue. So shall we wait shall we take a break of 15 minutes and continue? So it's a theoretical stuff we've been discussing. So there are a lot more slides to go. So let's take a break and continue, right? Okay, have a break of 15 minutes and come back. Let me pause the recording. Okay, fine. Now we are moving on to looking at the corporate governance and the corporate failure. We'll see. The corporate governance practices are often at the heart of the corporate failure. So as I said, or even as we witnessed, we have seen that the internal controls, the ineffective boards would predominantly contributes toward this corporate failure. So therefore, the corporate governance practices are at the heart of the corporate failure. The corporate governance relates to the duties and responsibilities of a company's board of directors in managing the company. So when come to this corporate governance code, you would find that it is more into the duties and responsibilities of the board of directors. So what are the responsibilities of the board of directors in managing the company and their relationship with the stakeholders, sorry, shareholders mainly. So you need to have a kind of communication with the shareholders. This could be mainly through uh, the meetings that you have with the shareholders, and even that could be through the financial statements, the communication that is possible, right? And other stakeholders. So when it comes to this corporate governance, it is not just assume kind of accountability towards the shareholders, but even it go beyond that. Even you may assume certain responsibilities towards the stakeholders. So your customers, suppliers, the government, the general public, likewise different stakeholders. Other than the shareholders, even you assume responsibilities. So the nowadays business organization, they would do that. So therefore, it is about the accountability towards the broader spectrum of stakeholders, not just the shareholders. So this is what we call generally the corporate governance. It is all about the directors, it is all about the shareholders, and it is all about the management, right? So that is what the corporate governance, and the key thing, it is about the accountability. The corporate governance influences how the objectives of the companies are set and achieved. So basically, the board of directors and its subcommittees, especially the management committee, they are in charge of setting the objectives of the entity. They would set the goals, and also they would set the strategies, especially the corporate plan. So therefore, it is something to do with the board of directors and the management committee. How the risk is monitored and assessed. Again, for that purpose, the responsibility is with the board of directors, and they have appoint a particular committee that is going to be the risk committee, the risk management committee, the organization would tend to have, and the committee would take care of the risk aspect. They would look into the areas where other things can go wrong, and they would look into that, especially even the performance measurement that also comes into play. So that is a kind of mechanism to ensure that the organizational members, organizational personnel would work toward the objectives that is set by the board of directors and the management committee. So in order to ensure that this performance need to be assessed, and that is also something taken care by the risk committee. And how performance is optimized. So that is about achieving a high performance. So that is something to do with the corporate governance. So they set the objectives, and it is more about the performance role. So when you come to that board of directors, they have the performance role and the conformance role. Conformance. So these two roles, they have to play that to the fullest. The performance is about achieving the setting objectives, setting strategies, and achieving the objectives. It's about the performance aspect. The conformance aspect is that it is about the compliance. It is about the compliance to the code of best practice, the corporate governance code. It is about the compliance. So whatever the rules, guidelines that is listed over there, so the board of directors need to ensure that their respective organizations are in conformance with these guidelines. So that is about the conformance role of the board of directors. So when it comes to this corporate governance mechanism, you can see that it is a kind of very comprehensive uh, area. So you would see that different mechanisms are there, and you can see in the note these mechanisms are not independent, but rather it is interdependent, and also that will constitute the corporate governance system. So these mechanisms are part of the corporate governance system, and at the same time they would complement each other, and even it may substitute each other. So when it comes to these corporate governance mechanisms, out of these many, you would pay more attention, as we repeatedly highlighted, the board of directors and its subcommittees. So they play a huge role, especially that the internal control mechanisms, right? They said that internal control mechanism, the audit committee, they would take care of that. And then the acts and regulation. So in Sri Lanka, we have the code of best practice issued by the Chartered Institute of Chartered Accountants of Sri Lanka, together with the Securities and Exchange Commission. They have this acts and regulation. The regulatory agencies are there, as I mentioned. Those would play a very critical role when it comes to the corporate governance mechanism. So apart from that, the ethical aspect is also there. That is most of the time taken care by the social values, the norms, reputation, trust. Those aspects, the social values are more towards ensuring, again, the ethical conduct of the business organization. So in a way, that would also become part of these corporate governance mechanisms. So likewise, this is what we call in general the corporate governance of an organization. It says that the strong corporate governance at a company level will have the following characteristics. So if the corporate governance is strong, then they must demonstrate the following characteristics. The board are active in setting and approving the strategic direction of the company. So as we said, it is all about setting the goals for the organization and even the strategies to achieve those goals. The board are effective in overseeing the risk and setting an appropriate risk level for the entity. And then they set the goals, they set the strategies, what they need to do. They need to ensure that the performance is measured, and then thereby they ensure that the objectives is achieved. The objectives or the goals is achieved. That is the case. And at the same time, they need to make sure that the management personnel is compensated fairly. That aspect also need to be taken into consideration. Apart from that, the operational controls has to be there in place. Those aspects would even cover here. So therefore, the board, if the strong corporate governance is there in an organization, they must show the following characteristics. The Business Week, it's annual. It's a kind of magazine that is published in the USA. It's a business magazine. The Business Week annually rate the board on their corporate governance. Boards on their corporate governance. The principles of good governance they look for. So what we call, or what we term as the good governance, it is about the independence. So when it comes to the audit committee should comprises the independent managers. It is about the risk aspect, the internal controls. The audit committee is in charge of the internal controls. So therefore, they must be independent. Then when it comes to the compensation and the nominating committees, so that must be dominated by the independent directors, or sometimes even that might entirely comprise of the independent directors. Yes, as I said, it must be made up solely of independent directors. So the audit committee, the compensation committee and the nomination committee, these committees has to be independent. Uh, in the instances where the entities have failed or the corporate collapses were there, that was because this independence was compromised. So in those instances, as I said earlier, even in case of this Enron, the HIH, we have seen that the internal audit function was subcontracted to the Arthur Andersen. So what about the independence? So independence is not there at all, right? It was subcontracted. So therefore, effectively, that particular layer was removed. So the internal controls compromised. The compensation and nominating committee, again, that is something to do with the independent directors. If not, what can happen? The managers and the board of directors can get compensated as they wish. As a matter of that, that would even dictate the end. Like the Golden Key credit card company, as we discussed, that was the case. So the compensation and the nominating committees, those are pretty much need to be independent. The stock ownership, and they have identified that it is better that each director should own an equity stake in the company. So each of these directors are having a kind of ownership, right? If you have ownership in the business, then that is your business. That is your business. So therefore, what you would try to do, you may try to work in the best interest of the company, because that is your company. So your interest, the personal interest, is aligned with the interest of the business. So that is what we can do by way of stock ownership. So the each director owns an equity interest in the company, so thereby the personal interest and the company interest was aligned. So when they try to maximize the personal gain, that in turn means they try to maximize the company value, because they are the owners. And also the direct equity, the independence, experience, the how active these directors, witnessed by the attendance at the board meetings, the number of directorships. So when come to some situation, we would find that when come to a particular manager, he is having directorships maybe more than 10 to 12 companies. In such an instance, I don't believe that that person can be effective, right? So it is something beyond their control. Or if that happens, what is going to be the case? That he is simply becoming ineffective. So he become ineffective in his activities. So therefore, the director quality should also be considered as a main aspect when it comes to good governance. The independence, the experience, attendance, and the number of directorships. And the board activism. The board should meet regularly without management present and should evaluate their own performance. So it is not just the performance of the management, it is not just the performance of the employees, and even this performance measurement should even extend to the board of directors as well. They themselves need to assess their performance. So it is a very good indication that the board activism. So they meet regularly and they evaluate themselves. Their performance is evaluated by themselves. So that is a very good characteristic when it comes to the corporate governance. Right. It is about the corporate governance. So we found that when the things go wrong with the internal controls, when the things go wrong with the board of directors, when the things go wrong with the management, it can dictate the end of the business. So therefore, in order to mitigate the chance of bankruptcy, the chance of business failure, it is good to adapt the guidelines that is provided in the corporate governance code. So if you take the corporate governance code of Sri Lanka, so the latest one, you would find that there are certain provisions for directors. There are certain provisions as to the management. There are certain provisions as to the shareholder engagement. So each and every aspect, the things where the areas where things can go wrong, everything they have covered. Everything, almost everything it has covered. So if we try to keep our organizations in line with this code of best practice, there's a chance that the business failure would be minimal. The business failure would be minimal if they keep up with the corporate governance code. Okay, would you like to add something to this corporate governance? Yeah. So in the organizations what you work, so do you see some positives when it comes to the corporate governance, or do you some lapses? Yes, likewise, when you can reflect on them to bring some, I would say, a practical perspective to the discussion. So we've been discussing heavy theoretical aspects. Anything? Okay. So let's continue. Now we are moving on to another important area. It is about predicting the corporate failure. Now we have identified what is corporate failure and the significance, the factors contributing towards them. We have identified the importance, I would say that the significance of this or the gravity of this corporate failure. Then what about predicting the corporate failure? A range of methods have been used to assess the corporate financial performance and to search for signs of financial distress. The range of methods have been used. So when it comes to the literature, there were different methodologies being used in order to predict this corporate failure. So the most, what you call the familiar one, it is about the ratio analysis. So you've been doing that since our A levels, that the ratio analysis, that is in a way would help to talk about the financial health of an organization, especially when it comes to these profitability ratios, the liquidity ratios. If these ratios are continuously deteriorating, we would find that something is wrong with that organization. So hence, the liquidity and profitability are of paramount importance. It's of paramount importance. Apart from that, we would see that when it comes to the literature, there are different models have been developed. The different models have been developed to predict the bankruptcy. So in those models even, they would use these ratios. So some of these ratios are being occupied in these models itself. For example, the Z score is one of the best known corporate failure prediction model. And if you look at this prediction model, see, as I mentioned, you can see that some of these profitability related and the liquidity related ratios are there. So the overall score is known by Z. Then you can see the X1, the first factor, it is about the working capital divided by the total asset. That is something to do with the liquidity. The retained earnings divided by the total asset. The next factor is more or less relating to the profitability. The other one is earning before interest tax divided by total asset. It is kind of return on asset. It is a return on assets. It is again the profitability. The market value of equity divided by book value of total liability. So it is about more about the long-term liquidity, I would say. It is about leverage. It is something to do with the leverage, the market value of equity divided by the book value of total liability. Then the sales divided by total asset, it is about the efficiency ratio, again, something you can relate to profitability. So likewise, this predominantly the efficiency related, the liquidity related and the profitability related ratios are being used in these models, and that is to predict the corporate failure. Then it says, what is the decision criteria? A Z score of 3 or more is a healthy one. If a company is having a kind of Z score of 3 or more, then we can reasonably conclude that it is a healthy one. If it is between 1.8 to 2.9, it could be the danger zone. But below 1.8, that highlights that there is a high probability of failure. So here, if I ask you that what could be the most significant factor that would be when deciding the Z score out of these several factors, what could be the most crucial one? If I just ask you, that is something to do with the common sense, yeah? Which could be the most significant one? Okay, good, we'll see. Return on assets, okay, good. Then it says assets, okay, yeah. Good, yeah. So it is going to be the X3. Why is that? You can see that when it comes to this particular return, so whatever the figure, what you get over here, it is multiplied by 3.3. So therefore, if this particular figure is tend to be high, then that is quite helpful in achieving a higher Z score. So therefore, if a particular entity is making good profit compared to the asset, but they have occupied, right? But they have occupied, their profits are good, then it suggests this company is doing well. So therefore, we can just say that the X3 is going to be a crucial determinant, and thereafter also this particular retained earning divided by total asset, as well as the working capital divided by total asset, those aspects would even play a crucial role because they are the figure, it's a high one, no? Good. So this is one of the models that is commonly used when it comes to the corporate failure. Studies have shown that the Z score has validity in assessing the Australian companies. So it was proven successful when it come to the Australian context. When it was applied in the Australian context, it was proven very successful. A variety of other models have been developed. The refined Altman's model, right? The Camel model and the Beanish M model. So likewise, these are different models what have been using in assessing or in predicting the corporate failure. And I have provided you with the additional reading on these different models. So, and you better read them leisurely. You better read them leisurely if you are further interested in this corporate failure. Then when you come to this Camel model, you can see that it is about the capital adequacy, the non-performing loans, then the net interest margin, the return on asset, the cost to income ratio, liquidity asset to total asset. Likewise, it is all about, again, profitability and the liquidity. So those two may come handy in predicting the corporate failure. That is another model what is being used in the context of corporate failure. The Camel model, it is a capital adequacy. A stands for the asset and management quality. M stands for, A and M stands for assets and management. E stands for earnings. L stands for liquidity. So what is this model is about? The Beanish model is a mathematical model that uses financial ratios and 8 variables to identify whether a company has manipulated its earnings. So when come to this corporate failure, that is something to do with the earnings management, the manipulation of earnings. And this model would help you to identify whether the company has manipulated its earnings. So it is a quite powerful model. It helps in deciding whether a particular entity has manipulated its earnings. So you can see that there they have used some financial ratios, the days sales in receivable index, the net receivable divided by the sales in the current period. Then you need to divide the entire thing by the net receivables divided by sales in the previous period, the gross profit margin, gross margin index, sales of the previous, the sales and the cost of goods. So it's a profit, the gross profit divided by the sales in the previous period divided by the current period, gross profit margin. Gross profit margin of the previous period is divided by the gross profit margin of the current period. The asset quality index, 1 minus the current asset plus the property, plant and equipment plus securities, in the sense investment. It is about the asset side divided by the total assets. Then 1 minus the current asset, PPE, securities in the previous period divided by total asset in the previous period. Then the sales growth, the sales in the current period divided by sales in the previous period. The depreciation, similarly, depreciation divided by the depreciation in the previous period divided by the depreciation in the previous period plus the depreciation in the previous period. Yeah. Then the depreciation in the current period is divided by the property, plant and equipment plus the depreciation. Similarly, you can see the sales general administrative expense index, the leverage, likewise the total actuals total asset, likewise 8, 1, 2, 3, 4, 6, 7, 8. 8 financial ratios were used in deciding whether the entity has manipulated its earning. So therefore, the earnings quality could be assessed. Earnings quality could be assessed through this model. Then most importantly, the decision criteria. I think that nowadays, you know that all these things are put into the systems. You would be able to work this out in no time. All what you need to do is just to feed these values. When the correct values is feeded, the computation is automatically done. Then you may come up with the result. So the most important thing is that you must be able to interpret that. You must be able to interpret that. So it says that when it comes to the interpretation, if the ME score is less than minus 2.22, it is less than minus 2.22, in the sense it can be 2.25, 2.6, likewise, no? It is less than, it is below, it is about the minus funds, right? The company is unlikely to be manipulated. So if this ME score is less than 2.22, then it is unlikely to be manipulated. But if this ME score is greater than this, if it is 2.1, if it is 1.8, if it is 1.5, likewise, the company is likely to be manipulated. If you are more towards zero, if you are coming towards zero, then it is an indication of a manipulation. Instead, if you are moving away from zero, if you are moving away from 2.22, then it is indicated that you are unlikely to be a manipulator. That is the most important thing, right? That is also quite helpful in order to decide the earnings are manipulated. So you can take your own organization, you can apply these models in leisurely, and you can see how the things is going on, how the things is going on. So, or even whether these models work within Sri Lankan context, it is yet to be decided. Okay, then
Sir,
you asked me
excuse
what
me,
if it is
sir.
2.22, right?
Sir, excuse me. The 2.22 is a indicating factor also, whatever it is.
2.22 is the kind of benchmark what they take.
Benchmark standard for that.
If it is less than 2.22, it is less unlikely to be manipulated. If it is more, then it is more greater than that, that is in the sense the company is likely to be a manipulator. No, it is 2.1, likewise. Then the question is that what if it is 2.22? Yes, it is. You can say it is neither manipulated nor not manipulated. So in this indecisive scenario, no, that is not the case. Here, these are just thresholds. I would say that this model itself may not be adequate when it comes to a practical scenario in deciding the corporate failure. So you can just take this as a starting point. These are quantitative, purely quantitative indicator. Then together with that, you need to consider even the qualitative factors, the other qualitative factors. Together with that would help to dictate the failure, right? So therefore, this is a kind of starting point, I would say. The number itself may not be helpful in deciding whether it is a manipulator or not. Together with that, you need to consider the other factors. This is currently used benchmark. To be honest, that I'm not quite familiar with the application of this model. I do not know, and even I have not undertaken any research in this context. So therefore, I have little information to talk about the applicability of this model, how to what extent that this has been applied in a Sri Lankan context. This is something what we can see. So whether this is something we practically use in the Sri Lankan context. Yeah, it's a good question for us to investigate. If anyone is having idea, can you contribute for that? Is anyone having understanding that when it comes to the corporate failure in the Sri Lankan context, are these models being used? Are these models having some value? It's mainly forensic accounting. Yeah, is that yeah? The one who is coming from that particular background, they could have some sort of understanding. No? Yeah, it is something for all of us to investigate the applicability of there. And probably, if you have not finalized your thesis, so you could have thought of this as a particular area, the corporate failure. But I think by now, you almost all of you have finalized your area of research. Okay, good. So we will investigate that. Then the indicators of corporate failure. The Australian Securities and Investment Commission has set up the National Insolvency Training Program. So they have set up the National Insolvency Training Program, which aims to make directors aware of their company's financial position. So having gone through these corporate failures, these are the regulatory actions. These are the regulatory kind of actions, I would say, that was embarked by different countries, right? So when it comes to this Australian context, they have formed this Australian Securities and Investment Commission and has set up the National Insolvent Trading Program. It's a kind of initiative of this organization. And what their aims? They want to make managers aware of their company's financial position. So it is pretty good that they educate the managers on their own company's financial position. So they educate the directors on their company's financial position and make directors of potential insolvent companies uh, aware of their responsibilities. And even uh, the companies, those who are heading towards the insolvency, they are explaining and they are showing what are the responsibilities of the directors, right? They make them aware. All these initiatives, you can understand that that is to uh, avoid, or even I would say that that is to minimize the corporate failures. So once the managers are become aware more of their responsibilities, once the managers are aware of their own company's financial position, then they would make or take decisions to avoid these corporate failures. So therefore, the main objective, I would say, in this particular program, that is to minimize the corporate failures. So they would encourage director to seek external advice from accountant, lawyers, and insolvency professionals. So those are what we call the administrators. They encourage even to seek advices from the insolvency professionals. The ASIC has identified some key operational and financial practices, which in combination with other practices indicate the company is at significant risk of insolvency. So these are some of the indicators, the financial and operational indicators that they had identified a company who is heading towards the corporate bankruptcy. The bankruptcy, a company who is heading towards bankruptcy, these could be the indicators. We'll see poor cash flows or no cash flow forecast. So the cash flows is a significant determinant of the corporate failure. So therefore, if you have poor cash flows or no cash flow at all, then this might threaten the company that they may be heading towards the corporate failure. And disorganized internal accounting procedures. So when it comes to accounting, it is not organized, it is disorganized. The absence of budgets and corporate plans. You don't think about the future, you don't plan, you don't have the strategic objectives, you don't have the strategies, you don't have the budgets, you don't have any. The continuous loss-making activity. So if you continue to make losses, that could even be threatening. Accumulated debt and excess liability over assets. So if your assets, the liabilities are more than the assets, then that means the negative net assets. So it is a result of accumulated losses. It's a result of accumulated losses. And the incomplete financial records. So if you are not maintaining a proper set of financial records, that could even be itself an indicator that something is wrong, something is going wrong in the company. So everything would eventually, these aspects need to be taken seriously, and so the proper actions must be initiated. Otherwise, the company would be ended up being bankrupt, Right. Indicators of corporate failure. Right. Let's see the indicators of corporate failure. The default on, we continue to discuss this. The default on loan or interest payment. So that is something obvious. So if you default on the loans and interest, if you cannot pay the loan installment, that's a problem. Outstanding creditors of more than 90 days. So you have failed to settle your creditors even 3 months old. It's more than 3 months old. 3 months, 3 months old, The installment arrangement entered into repay trade creditors. Even for the payment of creditors, for the settlement of creditors, you are looking for some installment plans. So it suggests that you have a serious issue with cash. The judgment debt, the debt that a court has ordered a company to pay. So you have some sort of debt as such. That means the creditors has gone, taken some actions against you. As a matter of that, you had to pay those claims. So therefore, it's a judgment debts. The significant unpaid tax and superannuation liabilities. So you have some unpaid taxes. Difficulties in obtaining finance. If you find it difficult to finance, again, it is something to do with the bankruptcy. The difficulties in realizing current asset. You cannot sell your assets, you cannot sell your stocks, you cannot settle your debtors. You find it difficult. Loss of key management personnel. So the key figures may be leaving the company. So all these things is an indicators of corporate failure, right? So therefore, it is an entity-wide phenomena. You can see that it revolves around the current assets, the current liabilities, and even the non-current liabilities. So likewise, it span across these areas. So you can see that here it covers the trade, what you call that, the current liabilities and the current, even the current asset section, even the long-term situation, the loans, all those things would mean the corporate failure. So therefore, the cash is also a significant determinant, right? Even if you look at this anatomy of the corporate failure, you would find the cash would play a crucial role. Yeah, these are some of the indicators, and I think that so it covers almost all the aspects of a business organization. Right. Then we look at the anatomy of a corporate failure. Let's look at some of the failures that has happened in the real world, and let's see what is the learning out there. Let's see what is the learning out there. There is often not one indicator that a company is likely to become distressed or fail. So the failure, as we learned so far, we have seen that there can be many factors can contribute, but eventually, we could see that the most of these factors are internal, or most of these factors is mainly something to do with the management. So we have seen that the management deficiencies is playing a crucial role when it comes to this corporate failure. That is the learning what we had so far. Superannuation of liability. In fact, I don't have an idea about that. I'm sorry. That the superannuation of liabilities, yes, in the previous one, I've seen that unpaid taxes and superannuation. So anyone is having an idea about this superannuation? I have not searched that. Certainly, you may be able to search through the internet. Superannuation. This is something like kind of something to do with tax or something. Superannuation. Maybe, no? Yeah. Regular payment made into a fund by a employee towards a future pension. Yeah, good. So you have searched through the so it is a kind of, yeah, it's a like we do for employees that a certain fund that we try to maintain on behalf of the employees. In that particular case, we have to make a kind of annual payment. So it's an annuity, no? It's an annuity. It's an annuity like payment, and it's a liability. Yeah, right. Then when we come to the anatomy of the corporate failure, yes, there can be more than one indicator that could contribute for this the failure or the distress situation. Among them, the cash flows has been seen to be a major contributing factor to corporate failure. So as we have witnessed, when it comes to the indicators, in almost all the indicators, we have seen that something to do with cash, something to do with cash. So therefore, cash flows has been seen to be a major contributing factor to corporate failure. So this was particularly the case when it comes to the retail sector. So when, especially, so as per your study text even, so when it comes to the Australian context, the most of the retail companies had gone bankrupt. That is due to the cash flow problems, together with some issues in the inventory management, the data management, together with these issues, and also the overexpansion, as we discussed earlier. Together with that, these cash flows has contributed the most when it comes to the corporate failure in the retail sector. Not only that, even the famous incident, even in the insurance sector, that was pretty much witnessed. The cash flow is a crucial one, because when it comes to that insurance industry, you would find that so the way they even nowadays we would see that there's a kind of aggressive kind of sales we may witness, especially the different offers are coming on during this pandemic. So even I myself have experienced like 4 to 5 insurance companies have approached, if I'm not mistaken, and coming up with different plans. So therefore, uh, so there they witnessed, especially the cash plays a significant role in the insurance sector. So all in all, the cash flows is a significant factor. And also another factor, as the The empiric suggests, as the empiric suggests, the deficiencies in the audit process have been played a kind of crucial role again in the collapses, especially the Enron and HIH. I repeatedly told that when come to the Enron, they have even outsourced their internal audit function to this Arthur Anderson, and also when it come to the past, what do you call that? The partners, they used to represent the management or the board of directors of this Enron, and even the Arthur Anderson has paid some kind of consultancy fees even to the Enron. Likewise, different kinds of uh, relationships was there. So the independence of the audit process was compromised. The independence of the audit process was compromised. And even as a matter of that, that has ended up, both the companies has ended up uh, being bankrupt. So that was another key issue what we have witnessed, especially in case of HIH Enron. What we see, the independence of the audit process is another contributory factor towards this corporate failure. So therefore, this could have been certainly addressed if you have complied with the code of best practice. Yes, to a certain extent, this could have remedy. The situation could have remedy. These can be compounded by conflict of interest. Yes. Then other factors, the lack of independence of the audit committee. So especially in these companies, we agree that when it comes to the audit committee, it must be represented or it must be dominated by the independent directors. But there may be instances where the directors were not independent. So when analyzed, the OneTel, the HIH, the Harris Scarf, the companies like this, when it was analyzed, it was found that uh, in these companies, no independent directors were there in the audit committee. So therefore, that is what the experience suggests us. The independence of the audit committee is of paramount importance. In fact, in the development of these corporate codes, these incidents have pretty much contributed. So when it comes to the development of the guidelines, that is based on the past experience. That is based on the past experience. So therefore, these aspects has contributed for the development of the subsequent codes, especially the Sarbanes-Oxley Act, followed by that Enron collapses, especially the Enron collapse, the Sarbanes-Oxley Act was passed. The ownership structure dominated by the single shareholder, that is also problematic. If one person is dominating, right, then that might mean that this lead to lack of independent directors, right? And the board dominated by the founders or even the relatives of the founders. So if that is the case, right, this would mean uh, that could also contribute towards a corporate failure. If one person is handling the companies, right, there's a danger. There's a danger. So, so even there are instances, even if you take the local context, you would find that, no? So there's one person who may be dominating a particular industry, right? So there's a danger in doing so. The lower than average proportion of the remuneration package for CEO, right? Even in the instances where you pay more, there's a chance of company being failed. And similar to that, when the package, the remuneration package of the CEO is tend to be low, that is even a risk factor. It was a proven fact. When the CEOs are paid less than the average, so that itself give a kind of motivation for these personnel, the CEOs to engage in kind of turning management practices. So they may try to achieve whatever the remuneration, whatever the salaries what they would require, but in an unacceptable ways. So even the fraud itself, the bribery itself can come into play. So this is especially the case. Even we So it's a well-known fact that even when it comes to that, especially that the traffic police, no? So we experienced that. So there was a very famous thing, no? So then even ultimately when we look at this root cause, so eventually it is something to do with the low salaries. So the lower salaries have itself encouraged them to engage in such kind of bribery practices. So therefore, the lower salary itself has to do something with that. And at the same time, the significant related party transaction, that could also be the case. The related, in the presence of related party transaction, that could mean the case. Yeah, you have shared personal experience through its work. Bankruptcy were present, but the audit report came out the free and fair. Not even imprisonment paragraph. The notes of the financial with many misleading information. The company bankrupt, yet the analysis show its circumstances. Companies have situation. Yeah. So that is yeah. So you're sharing some of the experience. Yeah. It is pretty much justify the things what we are discussing, especially when it comes to that the related party transactions, when it comes to that the independence of the audit committee, uh, the independence in the audit process, those factors are contributing towards the corporate failure the most. So it is even weakness pretty much, especially when it comes to the companies in Sri Lanka, the most of the time, as you highlighted, the private limited companies. Right. Then the most important thing, so followed by these significant failures, so it has gave rise to some regulations and political responses. So therefore, that is the good thing that was caused by these corporate failures. The corporate failures that has happened in the past has gave rise to some important movements like the regulation and the political responses. The significant corporate failures has consistently led to a focus on corporate governance and a demand for corporate reform. Okay, in Australia, the corporate failure in the 1980s were thought to result from inadequate accounting disclosures. So in the initially, in 1980s, they thought that it was something to do with the accounting disclosures. Inadequate accounting disclosures could itself contribute to corporate failure. Perceived this limitation in the corporate governance legislation that led to the collapses of Enron led to the US, the Sarbanes-Oxley Act in 2002. So this is a very positive movement that happened in the US, followed by the Enron collapse. So the Enron collapse, it has made a huge impact to the US context, the US community. Then followed by that, the government has taken the actions to pass this Sarbanes-Oxley Act in 2002, and that provides the corporate governance code. Subsequent corporate collapses in Australia have also been used to justify the Financial Reporting Council. They have introduced the Financial Reporting Council. They introduced the International Accounting Standard from 1st of January 2005, or they have adopted the International Accounting Standards from 2005. But in our context, it was from 2012. And also the establishment of the Australian Stock Exchange Corporate Governance Council and publishing best practice corporate governance guideline for listed companies, that was in 2003. That was again a result of these corporate failures. The corporate law economic reform programs, so that is again they have strengthened their corporate law. That is also kind of positive movement followed by these corporate failures. So likewise some regulatory movements has happened because of this corporate failure that was witnessed in different contexts. In the dominant context like USA, the UK, and the Australia, in this context, this has happened, right? And even in Sri Lanka, I believe that the corporate governance, the development of the corporate governance code may have been encouraged by these corporate collapses. Whatever the failures that we have gone in the past would have compelled us to establish a very strong corporate governance code. Right, that is all what we expect to discuss so under this section. So with that, we mark the end of the lecture series of our course. As I said earlier, so we are going to have a kind of review session. So we promised you that. So before your examination, we are going to provide you with kind of understanding of how you are going to be assessed, the type of exam questions, and how you must approach them. Likewise, very informative session we expect to have with you on this Thursday. So make sure to participate that. It is 15th from 6 to 8. And that will certainly help you in approaching your examination, right? So we understand that when come to the masters, even we ourselves have experienced that the managing studies and managing the work is not going to be an easy task. So having understood that, so we are concerned towards that. So hence we would like to share with you that how you are going to be assessed and the areas that you must concentrate. Those information we are ready to be shared, and so that is going to happen on this Thursday. So participate for them, and at the same time, those who did not do the presentation, so make sure that you are going to make yourself ready. You have 1 week time. In the Saturday, we are going to meet the usual time and take your presentations and do them to the well. So far, you all have done well. You all have got good marks. So keep doing the other teams as well. Right. Then that's it from my end. Then thank you very much. So it is pleasure that to engage with you. It was my second batch. Yeah, my second batch. I joined with this master program last time, and it was quite happy to share the knowledge with you. And thank you very much for that. What about past papers? Yeah, let me check with Atula sir. Let me check with Atula sir. We'll come to the next class, and let's see whether we can share that with you. In fact, when it comes to the discussion, we are going to take some past paper questions and discuss with you. And apart from that, let me see or let us see whether there is possibility of sharing with you the past papers as well, right? Is there any possibility to know the presentation marks? Yes, again, that is something I might discuss with the Atula sir, the coordinator of the program, and we'll try to. So I think it must be published. Yeah, the marks usually we need to publish. We usually publish, so therefore we may share them with you before the exams. So as I said, that everyone has got good marks, so keep doing that. Okay, then thank you very much. So if you have any questions, yes, now it is the time we can discuss, depending on what we discussed today, or otherwise we can wind up the discussion now.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you very
Thank
much,
you,
sir.
sir.
Right, thank you.
Thank you, sir.
Very much.
Thank you, sir.
Right.
Thank you very much,
Next
sir.
class. Right.
Thank
See
you,
you
sir.
next class.
Thank you, sir.